Your employer offers a 401k. They match it. They auto-enroll you, and they set it as the default before you ever fill out a single form. What they don't do is sit you down and walk you through how that 401k is different from a Roth IRA. One account gets the full benefits package, the welcome email, the lunch and learn. The other barely gets a mention. The default was chosen for you. That gap between what you were sold and what you were never told isn't random. By the end of this video, you'll know exactly who it serves. Start with the one fact most people skip right past. Every dollar sitting in a traditional 401k has a tax bill attached to it, an envelope you have not opened yet. You will open it later, in retirement, on the government's schedule, not yours. To keep this fair, meet Tyler and Marcus. Same income, same monthly contribution, same 30 years in the market. The only thing that separates them is the account they chose to put the money in. Everything that happens next comes down to that one decision. By the end, you'll understand three things. Why your employer comes out ahead when you pick the 401k. What that deferred tax actually costs once the paychecks stop. And the exact order to fund both accounts so you walk away with the most money. On this channel, we run the actual math. So let's run it. On paper, the 401k looks like the easy win. The match feels like free money, and to be fair, part of it genuinely is. Pre-tax contributions shrink your taxable income today, so every paycheck lands a little lighter on tax. It feels like you're getting away with something, so Tyler leans all the way in. He maxes the 401k, watches the balance stack up year after year, and starts to feel like he cracked the code. His coworkers come to him for tips. Marcus, quietly funding a Roth IRA off to the side, just gets a polite nod at lunch and goes back to his sandwich. For 3 decades, Tyler looks like the smart one. The scoreboard agrees with him, right up until the day he retires. Then Tyler retires, and the envelope comes due. Every dollar he pulls out of that 401k counts as ordinary income, taxed at whatever rate applies the year he needs it. That is the quiet catch nobody flagged on day one. He deferred the tax during his highest earning years and handed the bill to his retired self. The version of him living on a fixed income with the least room to absorb it. And it gets sharper. At 73, the government requires him to start withdrawing money, whether he needs it or not. These are called required minimum distributions, and they exist for a simple reason. The IRS has been waiting decades to collect, and they are done waiting. Those forced withdrawals do something else too. They can push more of his Social Security into the taxable column, up to 85% of it. So now it's income stacking on top of income, at the exact moment Tyler has the least flexibility to manage any of it. The account that felt like winning turned into a bill with a due date he didn't pick. Now, if you went all in on the 401k like Tyler, you didn't make a dumb choice. You made the design choice. Defaults exist to be accepted. The auto-enrollment, the match, the paperwork, already pointing one direction, every piece of it gently walks you through the door that was standing open. Nobody walked you over to the second door. Most people don't even know it's there. So of course you didn't take it. That's not a personal failure on your part. That's a system doing precisely what it was built to do, and doing it well. Let's run the actual numbers. And remember, these are illustrative figures meant to show how the structure behaves, not a forecast for your account. Both men invest the same way for 30 years. Because Tyler's money goes in before tax, more nominal dollars land in his account. In this example, he finishes with about $1,238,000. Marcus contributes after tax into his Roth, so fewer dollars go in up front. He lands around $885,000. On the screen, Tyler is ahead by more than $300,000. Case closed, it would seem, but that 401k balance is a pre-tax number, and pre-tax is not the same as yours. Apply a blended 22% tax across his retirement withdrawals, and Tyler actually keeps something closer to $965,000. Marcus keeps all $885,000 because he already settled up on the way in. The gap that looked like $300,000 quietly collapses to around $80,000. And we are not done with Tyler's bill. Across a 25-year retirement, the tax on his withdrawals can total well over $188,000. His first required withdrawal at 73, calculated off that balance, lands somewhere near $46,000 of taxable income he did not choose to take that year. And a slice of his Social Security gets dragged into the taxable column right alongside it. Marcus, drawing from his Roth, reports none of it. Not the withdrawal, not the tax, not the paperwork. So why does the whole system lean so hard on the 401k? Follow the incentives. When your employer matches your contribution, that match is money they get to deduct, and unlike a normal salary dollar, the match isn't hit with payroll tax. Matching is simply a cheaper way to pay you than a raise of the same size. That isn't a scandal, it's just math. And it explains why the match is the one piece they are genuinely happy to advertise. It helps you and it helps them at the same time. Above the match, though, the picture shifts. The Roth option often lives inside that very same plan, sitting right there on the menu. But it rarely gets the email, the seminar, or the nudge. It's offered, it's just never promoted. And step back further, because the broader financial industry has its own reason to prefer big tax-deferred balances. There are trillions of dollars parked in 401k accounts in this country. That money sits under management, generating fees year after year after year. The structure that's most convenient to default you into also happens to be the one that keeps the most assets inside the system the longest. When something gets offered to you that aggressively, with that much momentum behind it, it's always worth asking who else is winning when you say yes. Now let's be fair to the 401k because it earns a real defense. The match is the best deal in all of personal finance. Capturing it is an instant 100% return on day one, and nothing else in the building comes close. You take it every single time. For high earners in their peak years, deferring tax now and paying it later, possibly at a lower rate, is genuinely smart planning. The contribution limits are roughly 3 times higher than a Roth IRA, so for aggressive savers, the 401k has room a Roth simply doesn't offer. And for anyone who struggles to invest consistently, automatic payroll deductions quietly build wealth they might never have set aside on their own. The 401k is a genuinely good tool. The trouble only starts when it's the one door anybody bothers to show you. Let's check the scoreboard. Tyler, all in on the 401k, builds about $1,238,000, keeps roughly $965,000 after tax, and hands back more than $188,000 across his retirement. Marcus, all in on the Roth, builds about $885,000 and keeps every dollar of it, with a retirement tax bill near zero. But the real winner is the door neither of them took on its own. Capture the full match inside the 401k, then load the Roth on top of it. That combination grabs the free money, layers tax-free growth above it, and leaves you with the most flexibility and the smallest lifetime tax bill of any path on the board. Here's the rule to carry out of this video. The match is free money, so you always take it. Every time, no exceptions. But every dollar above the match is a tax decision. And a tax decision deserves a lot more thought than whatever default your employer happened to set for you. Free money is automatic. Tax strategy is something you choose on purpose. So here's the order that actually works. First, fund the 401k up to the full match, because that's free money and it always comes first. Second, max out your Roth IRA. For 2026, that's $7,500 and it grows tax-free for the rest of your life. Third, circle back to the 401k and push toward the contribution limit if you've got the room. Fourth, anything still left over goes into a regular taxable brokerage account where you keep full control of it. Match Roth 401k brokerage. In that order. Next time, we take identical $500 a month contributions and run them across 4 different generations. Same money, same discipline, wildly different outcomes. And the reason has almost nothing to do with the people and almost everything to do with the decade they were born into. That one is going to change how you think about timing. We'll run the actual math on it then.